You may be wondering whether or not you should change your portfolio going into this highly contentious election season. Today, I'm going to give you 3 reasons that changing your portfolio because of your politics doesn't make sense, and I'll share why maintaining your properly allocated and broadly diversified portfolio as is might be the better choice. If it's helpful, please subscribe below and share with someone else you think might benefit. In the last couple of weeks, we've been getting many questions about how the chaos of the election is going to affect our portfolio decisions. Now, before we get into the reasons, I just want to remind you that chaos almost always rules the markets. Nothing in markets is ever or has ever been predictable, controllable, or really even explainable. So in a very large sense, nothing has changed. I think the main thing to keep in mind is that current or expected chaos has little to do with equity performance. The fact, with which I do not disagree, that there's going to be political turmoil over the next few months has nothing to do with the long-term value of the companies we own. There will be, and always is, short-term uncertainty that leads to volatility, but we can't predict short-term outcomes in either direction, and that's okay, because in the long term, it's the earnings that create company value and bring about higher stock prices. So, here are 3 reasons you should simply stay the course as long as you're already asset allocated and broadly diversified. 1, there is no consistent evidence that tells us that one party is better or worse than the other in terms of market or economic performance. The few data points that we have aren't enough to consider a statistical sample, and the averages are very easily skewed by a few large outsized events like the Great Depression, the dot-com boom and bust, the Great Recession, and now COVID. So the historical data doesn't support party preference when it comes to market expectations. 2, the election is not the only thing that's going on. September has historically been the worst month of the year for stocks going back 100 years. And it's more likely that current volatility is a function of Congress not passing economic support than it is an expectation about the election. No one can predict or control short-term outcomes. We cannot know, but it's just as likely that markets go up over the short term than it is they go down. In fact, more so. Thankfully, as goal-focused and planning-driven investors, we don't have to make the call about the short term. Instead, we can focus on the things that make the long-term difference. As always, there are a lot of individual data points and a lot of pundits out there who grab 1 or 2 individual data points and use those to make a prediction. You can ignore those pundits. 3, long-term personal financial rules have not been suspended. Volatility is normal. Earnings, the thing that matters in the long term, they're actually going up. And in portfolio construction terms, the equity risk premium, that's the additional return we expect from owning equities, is higher than ever because bonds and cash pay almost nothing. As a result, many asset allocators are actually recommending an increase to equity exposure at this point. If we were to sell, what would we do with the money? There's nothing else to own. Given the uptick we see in inflation, holding cash and fixed income is potentially more expensive than holding equities. So there is not evidence to prefer one party over another from a market perspective. There's way more going on right now than an election, and the rules of long-term personal financial decisions haven't changed. Staying the course, again, as long as you're broadly allocated according to a plan and globally diversified, is the right way to go. I hope this helps in the short term. Let us know in the comments below, subscribe, and like and share this video. It really does help us out. Now, if you're a client, I intend to go much deeper on this subject in our client Q&A on October 19th, so look out for that invitation. It's coming in your email. Remember, no one can predict. This is why we remain planning-driven and forever mindful of the limitations of our knowledge about the future. Thanks. We'll see you next time.